So let's move on and learn how to trade volatility. So VIX index is a number that is computed from the pricing of option chains on SPX, the index Standard & Poor's, and it reflects a 30-day forward volatility on the broader market. And basically, it has an opposite direction or relation with XPX. So basically, when XPX starts to fall, institutions and everyone starts to buying calls to protect their portfolio, and this increases the volatility of the calls, and VIX is computed with those values, and it is increasing. So that's an inverse relation between VIX and XPX. So majority of time is below 12, although in the past 2 years there was a decreasing tendency, as you saw by the graph that I put on VIX with a decreasing yellow arrow. And this was because during those 2-3 years, market was consistently increasing, and VIX also was decreasing. Especially until last February, where there was this big explosion in volatility. So, but the biggest property of VIX and volatility in general is that it is mean reverting, which means that when it is high, it tends to come down. After the uncertainty passes and market understood that calm should come, there's a drop in volatility, and it stays near its average, which in the long term is about 15-14. Okay, so when it is going low, in the 9-10 range, as it is in the past, especially before the February increase in volatility, it stay there for a long time. But when it pops very violently. So that's why in the other courses I teach how to protect, especially in the short term. So what instruments do we have to trade volatility? So basically they are ETNs, exchange trading notes, that basically they try to mimic the VIX. And basically they are the only assets that are volatility related, especially with the border market on XPX. And there are currently 3, there are a little bit more, but these are the main ones, especially the XX, which is the most liquid, and it is positive correlation or long volatility. It's a positive correlation with VIX with 1 times leverage, and has options. Okay, so the other 2 are less liquid, like XVXY, which is a short volatility, which is an inverse relation with VIX. So when VIX goes up, short volatility XVXY will decrease. So it is the leverage is 0.5 at this moment. Before the crisis in February, it was 1 time leverage. UVXY, it's similar to VXX, but it has a leverage of 2 times, which means that when VXX is gaining 1%, UVXY is gaining 2%. So both of these last 2 have options, but due to the high spreads, I do not trade them, and as they are not so liquid. So VXX is the most liquid instrument with tight stock and option spreads. So let's move to the next chapter and see the concepts of VIX futures pricing structure.